Good morning, it's Jeff Christian from CPM Group. It's 11 o'clock on October 1st, first day of the last quarter of the year. I wanted to talk about our market update. Precious metals prices fell very sharply this week. They came back a little bit yesterday. I'll talk about that. But before I do that, I want to talk, and then I'll also talk about the debt ceiling and its relationship to precious metals and what it might mean for precious metals. Before I do that, I want to say a few words about the Silver Symposium this week. I was in Idaho for the first Silver Symposium. It was a very interesting event. The most interesting thing that I saw was that in the old Silver Summits, which went from 2003 to 2017 or so, you had a lot of people who were very vehemently believing in conspiracy theories and all kinds of strange ideas about market suppression in silver and gold, and they were quite vociferous about it. This time, we had one troll, but we had a lot of positive responses to our videos, to our reports, to our perspectives on the markets, to the information we're providing the market free that's countering a lot of the misinformation and our presentations. It's clear that there are a lot of people who are concerned about what's going on in the economy and the markets, and they don't quite understand it. You know, there are things that are solvable in terms of fiscal policy in the United States, but the politicians aren't solving it. And it's not clear why they're not solving it, because it's pretty obvious how you move things forward. And people are searching for credible explanations. They turn to the internet and they see and absorb these nonsensical conspiracy explanations, but they're much less ready to accept them and absorb them than they used to be. And there's a very positive engagement that we saw at the Silver Symposium and that we're finding elsewhere. Now, one of the things I talked about, I gave a presentation and two presentations and participated in two open discussions. And one of the things that I talked about in one of my presentations was look at the data on trading, not only in silver, but across all commodities. And I have a slide in the table here that I'll show you. We're probably going to produce a special report, brief special report showing the results in greater detail and explaining them in greater detail. But what we did is we looked at the COMEX March contract in silver and the trading volumes in January and in February of this year on the March contract. And you can see at the bottom of this chart, these are the trading volumes. And you can see there are a whole bunch of periods when the prices spike higher. And one of the points I make, not only in Idaho, but on an ongoing basis, is a real researcher will look at all of the data and say, what am I finding here? A demagogue will pick out a piece of data and say, oh, look, here's a period of high trading volume and the price fell sharply. Clearly, someone's whacking the market, smashing the price down, trying to suppress the price. But a real researcher will look at it and say, well, look, there's a whole bunch of these periods of abnormally high trading volumes. Let's look at them. And this is the data. Oops. This is the data. We looked at, there were 5,287 10-minute periods of trading in January and February. And we looked at those trading periods, those 10-minute intervals, and we said, what's the first standard deviation? You know, up to 1,574 contracts trading in 10 minutes. That's the 91.3% of the time. That was 1,500 or fewer contracts trading in 15 minutes. Second standard deviation, the ceiling was 2,537 contracts in a 10-minute period, and that was another 4.8%. There were 207 periods of time where more than the second standard deviation were there. And interestingly, it went out it went up. But it was 3.9% of the time you had third standard deviation or higher trading volumes. And if you looked at those periods of abnormally high trading volumes, what you found, 97 of them related to rising prices, significantly rising prices, 95 of them related to declining prices, and 11 of them saw no price change. So a demagogue says, well, let's focus on some of those 95 and we'll say that it's suppressing the price. A researcher or somebody who really understands the market or wants to understand the market will say, no, let's look at all 203. And what we find is a normal dispersion. Then, and this, we just looked at silver in 2 months, contract months, one contract month and two months of trading, 5,287 periods, 10-minute intervals. But if you do this work across commodities, not even just gold and silver, but wheat, what you find is similar dispersions of abnormally high trading periods that sometimes correlate with rising, sharply rising prices, and sometimes correlate with sharply declining prices. So as I said, it's very interesting. It kind of lays bare that there's no statistical basis for the demagogues claiming that someone's trying to smash down the price. But if they're making a living promoting the concept of conflict, we're not going to change their views. And if they're what we call conflict addicts who get off on this kind of stuff, we're not going to change their views. And if they're true believers, we're not going to change their views. But for the vast majority of people who are concerned about what's going on in the economy and markets and really want to understand it, this helps them understand that what they're looking at is the way markets work. Not just commodity markets, actually, but all markets work. Financial markets, equity markets, bond markets. You can find similar dispersion of trading volumes and high periods of abnormally high periods of trading volume that correlate to both rising and falling prices. This is the way markets work. And for reasonable, rational market participants and observers, this should give them some comfort. Speaking of lack of comfort, let's look at the markets. As I said, we had a very sharp decline in gold and silver, platinum and palladium this week. And then on Thursday, we saw something of a recovery. Prices are modestly higher today. To understand what was going on, take a step back from the precious metals markets and look at commodities. Oil prices were rising sharply this week for oil-specific issues. Virtually all of the other commodities, not only precious metals, but base metals and grains and tropical soft commodities were falling. The equity market was falling. Bond prices were falling as interest rates were rising. Clearly, what was driving these markets down was not specific to gold or silver or platinum or palladium. It was a broader issue. And the broader issue was the Fed, the market starting to adjust to the idea of rising interest rates. The fact that the Fed may increase interest rates sooner rather than later, and that the Fed is going to taper its bond buying programs as the economy strengthens and recovers and moves further into an expansion phase. So what you saw was a reaction to the Fed policies and a view that interest rates are going to rise. Now, the Fed still says that it probably won't see, it'll see 2% in the Fed funds rate in a couple of years. And on a long-term basis, it looks for 2.5% Fed funds rate. That still gives you negative interest rates once you adjust them for inflation. And it doesn't necessarily show interest rates being so high as to cause investors to say, who needs to buy gold and silver? I can get negative 1% or whatever the real interest rate is on my investments in treasuries. So the interest rates rise, and you see a lot of people who use valuation models based off of US Treasury rates. As the interest rates rise, even if they're rising only a small amount, and I think the increase so far over the last 2 weeks has probably been on the order of 20 basis points, 0.2%. as interest rates rise, their computers say, well, if interest rates are 20 basis points higher, then the stock market and corporate bonds and commodities should be commensurately lower. So we've seen that kind of selling. We are not convinced that the selling's over. We still are adhering to the idea that the prices will strengthen over the next 3 months in the way they have traditionally on a seasonal basis. But we do think that there could be further weakness in the next week or two as the markets continue to adjust to a changing interest rate environment. So we're looking at downside exposure for the next week or two, but then for the rest of the quarter, we think that the prices might rise. That's traditionally what you see in the fourth quarter in gold and silver. But again, as you can see here, in 2019 and then again in 2020, we had an atypical price pattern in that the prices rose for gold and silver to peaks in early August, the first week of August, and then we're weak into December. And that's happened the last 2 years, and it's reflected the economic realities that were going on. In 2019, you had investors worried about us moving into a recession in the first half of the year, which kept prices down, and then or kept prices up, pushed prices up. And then you had this period of time in the last 4 months of the year where people said, no, we're not going into a recession. And the prices of gold and silver drifted down. 2020 was obviously the pandemic, and you saw the prices rise sharply into August, and then they started falling, and they fell really into the beginning of December, started rising in December, rose very sharply in January, and they've been, pretty much down since then. We think still that the more traditional scenario of modestly higher prices in October, November, December will prove out this year, but we're keeping a big eye on the economic environment and its implications on the prices, because we could see a third year where that's happening. And it definitely has started out that way in September. Now, on the debt ceiling and precious metals prices, CPM Group issued a market alert. We send market alerts to our paying clients, and that includes clients who have joined our retail investor programs that we've started this year. We sent out a market alert yesterday because a lot of people are concerned what's going to happen, what will be the effect on gold and silver prices of the debt ceiling fiasco that's unfolding in Washington. And our basic view is that the debt ceiling is likely to be increased before we face a default. It's a kind of a silly thing that goes on in Washington. Since 1960, I believe there have been 78 times when the debt ceiling has been raised. And interestingly enough, each time the party that's not in the White House causes trouble in Congress and balks and tries to extract political kudos by being nasty and obstructive. And interestingly, I think the majority of the time, by a vast margin, has been when you had a Republican in the White House, the Democrats in Congress have acted infantile. But it happens also when you have Democrats in the White House and the Republicans in Congress act infantile. We think it gets resolved. We sent a market alert to our paying clients yesterday. And in it, we talked about one of the more interesting incidents. People ask us a lot about the US government's attitudes toward gold and the Fed and the Treasury. And for the most part, since 1971-72, the policy within the Treasury and the Fed is we'd rather not talk about gold. We'd rather not hear about gold. We just don't want to engage in that discussion, because if we say anything about gold, the gold conspiracy theorists are going to start saying that we're secretly selling gold and there's no gold in Fort Knox. So basically, it's hands off when it comes to talking about gold in public. There was an exception to that in the 1990s. The Clinton administration was facing the need to raise the debt ceiling. The Republicans in Congress held up those talks. They held them hostage, trying to make political gains. And there was a press conference in which the Secretary of the Treasury, Bob Rubin, who was one of our stronger supporters when we were part of Goldman Sachs, reporter asked Bob Rubin, what happens, we've got furloughed workers, is there a risk of the government defaulting? How are you going to finance things once you hit your debt ceiling completely? And he said there are many ways that the US government can come up with shorter term and maybe longer term solutions to provide financing. For example, we could sell some of our gold. It's one of the few times that you'll see a Treasury Secretary in modern times, since we went off the gold standard in 1971 and went to more floating rate dollar rates from 71 to 73, 74. One of the few times you'll see a Treasury Secretary talk about gold in public. And it was very interesting because you see, there's a lot of gold mined in the United States. It's mined in Western states that have Republican senators and Congress people. And I think it was 24 hours, it might have been 48 hours after he said, hey, if we need to be, we can sell some of the 261 million ounces of gold. We have the discretion. We don't need Congress to do that. We could sell that gold if we really need to because the debt ceiling hasn't been raised. And lo and behold, within a day or two, the debt ceiling was raised. So I'm not sure that we're going to get that desperate, but over the next 18 days, we'll see how infantile the politicians in Washington can be. And who knows, you might actually see somebody say, hey, we can always sell gold if we need the money. And that could resolve it very quickly. If that were to happen, you could see the gold price spike down. Probably won't happen. There are other scenarios which we talk about in the market alert, but I won't bore you with them today. Have a good weekend. Enjoy the autumn if you're in the Northern Hemisphere. Enjoy the spring if you're in the Southern Hemisphere. And we'll talk to you next week.